us a brief overview of the trading day that was over in Kenya today.
Yes, good afternoon. The market is still just hovering over the 4,000 mark. Not too much activity yet, despite the Q1 results from several counters. So still not too much market moving news yet.
Well, we've been drawing a significant distinction between local and foreign investor participation in this market, with local investor activity waning and that, of course, of foreign investors growing. Now we've had news this week that the NSE Footsie Agreement is set to boost foreign investor interest further in this market. What have you made of that announcement of a new partnership?
Oh, that's some pretty good news coming through from this end, in that the Footsie arrangement would hopefully spur the Nairobi Stock Exchange exposure to the other global markets. So that should increase international insights on the local market, the Nairobi Stock Exchange. As you know, several other frontier markets already have this kind of arrangement, and even emerging markets such as yourselves in South Africa with the JSE and Footsie Agreement.
Well, it certainly puts a spotlight on the more prominent and liquid counters over in Kenya. To what extent do you see lack of liquidity that presents itself on most fronts still presenting some challenge, though?
Yes, the liquidity issue really is for local players, the local listed companies, to try and navigate through. So given that in the global market space, the capitalization is really often an issue, so we'll still continue to see companies that are over, say, $2 billion in market cap continue to excite more interests. And those are the top 5 or so capitalized companies on the NSE, which just hover about the $2 billion mark.
What impact then do you see this having on local investors' strategy in this market at this stage of the game, where we're still very early on when it comes to an agreement being settled on in terms of that relationship?
Well, we are seeing several players already take a position in terms of trying to increase their liquidity. For example, Barclays, who are coming out with a share split. We have Diamond Trust Bank coming out with a bonus issue. These are the small measures that would actually go a long way in increasing liquidity, increasing interest in various counters. So all in all, this is good news for the local market.
Of course, in a context where we've had local investors coming under pressure on account of rising inflation. And yesterday we took a closer look at KPLC's plans to raise electricity tariffs and what that spells for the company's value proposition itself. Taking it further, it also means, Kimathi, high production costs and consequently higher production figures that manufacturers pass on to consumers. So where rising inflation is still a problem, what's your reading of the macroeconomic picture over in Kenya at the moment?
Well, it looks pretty bleak right now, in that everybody is trying to pass on whatever they can to the next person down the line. So KPLC increasing their electricity cost will spur higher production cost, which also in turn will again increase inflation aspects to the local mwananchi, we call them, the local man. So it's really an inflationary cycle, and there is no end to it unless the central bank comes in and increases the liquidity issue in terms of reducing the currency which has been really falling against the greenback in particular. So unless the central bank steps in and tries to stem that reduction, then really everybody will continue passing on the costs to the next person.
So let's use a concrete example here, that of Samir Africa. It's one of those companies that's impacted by high costs, that of power, but also raw material costs that it incurs, with the flagship brand Yana tires manufactured locally. To what extent is a company like Samir actually able to pass on those costs to consumers, where we know consumers are still under significant pressure?
Well, it all differs with different companies, and as an analyst, one of the key issues to look at in investing in a particular company is the ability to pass on this kind of thing. Looking at Samir in particular, they are in between a rock and a hard place in that the costs are rising, the production costs are rising. On the other hand, we have imports coming in which are lowly priced, so that has the effect of these imported products appealing more to the local consumer. So, for example, as far as Samir goes, it's a very interesting counter, and we look to see what the future holds for them, because they're really between a rock and a hard place.
Well, Samir does boast somewhat of an import tire element, where a tenth of its tire product or sales volumes does come from Bridgestone tires, which has originally been imported from Japan, now from Thailand. Do you see the company growing that segment of its business, where we're looking at it selling more imported tires?
Well, it's likely that the company may shift in that kind of line, though even when they bring in the Bridgestone, it's at the expense of their local brand, Yana Tires. So it's not particularly the best move for them. And one remains to see what the kind of impact, the effects of Japan in particular will have. Perhaps I think this will be a short-term agreement while the Japanese scenario is sorted out.